Thanks everybody for coming. I really appreciate it. If you haven't already, there's food and beverages. I think everybody's satiated, but please help yourself. I'm David Mitchell, Senior Fellow for Tax and Regulatory Policy at the Washington Center for Equitable Growth. It's my pleasure to welcome you today, both those here in person and those joining us on the live stream, to the promise of equitable and pro-growth tax reform, a discussion of how evidence-backed changes to the U.S. tax code can buck recent regressive trends and instead spur strong, stable, and broad-based economic growth. This is an issue we at Equitable Growth have been prioritizing for many years. For those who are not familiar with our work, Equitable Growth is a nonprofit research and grant-making organization dedicated to bringing academic rigor and expertise to economic policy debates that have a major impact on inequality and growth. The tax code is, of course, a major driver on both counts, helping to determine if the economy will deliver equitable growth or enrich the privileged few at the expense of the middle class and historically underserved communities. So that's why the impending tax debate, triggered, as we all know, by the expiration of a number of Trump tax cuts, goes to the heart of our mission, and we think presents an opportunity to policymakers to reimagine how taxes can both raise additional revenue for critical public investments and ensure the U.S. economy is working for all. To ensure we take advantage of that opportunity, we at Equitable Growth, along with more than 100 like-minded organizations, identified three main goals for tax reform in 2025, which we included in a recent letter that we sent to congressional leaders. And I think those goals provide a nice framing for today's event, so I wanted to reiterate them now, and I think many of the leaders from those other organizations are here with us. The first was to make the tax code fairer by asking wealthy households and large profitable corporations to pay a greater share of their income in taxes than they would if the provisions of the TCJA were allowed to expire. I think the key thing here is it's not just about treading water, it's about pushing back on decades of regressive tax cuts as well as loopholes that have made the code unfair. The second goal is to raise more revenue than would be generated by letting all of the temporary TCJA provisions sunset. And we know from last month's Congressional Budget Office report that the cost of extending the tax cuts is over $4.5 trillion over 10 years. So we know that's not the best use of that money. And third, support greater and more inclusive economic growth by narrowing racial wealth gaps and disincentivizing economically harmful conduct by large corporations. In other words, reforms to the tax code are not just about fairness and revenue, but also about building the economy that we all want to live in. Of course, replacing the failed trickle-down policies of the past will not happen easily or automatically. It will require both a robust evidence-based and creative vision, which is what today's event is all about. So what do we have in store for you? In a moment, we'll be hearing from Senator Elizabeth Warren, who you all know is a visionary leader on all things economic policy. Following the Senator's remarks, we will welcome a panel to the stage for more in-depth conversation about concrete tax reform ideas. And that panel is moderated by Equitable Growth Senior Policy Fellow Michael Linden, and it will discuss individual taxes, particularly new ways to combat wealth inequality, as well as business taxes and enforcement to ensure that all firms are competing on a level playing field. And during the panel, we will be fielding questions, so there are index cards on all of your tables. If you'd like to submit a question to one of the panelists, just jot it down during the panel and find one of my colleagues and we'll bring it up to Michael. Okay, with that, it is now my distinct honor, at the end, we're going to hear from Daniel Hornung. I almost forgot about the last part of the agenda, who is the Deputy Director of the White House National Economic Council, and will lay out the administration's thinking on priorities for next year's debate. Okay, it is now my distinct honor to welcome to the stage a tireless champion for economic and social justice, a determined legislator fighting for the middle class, and according to social media, the mom of a very cute golden retriever, the senior senator from Massachusetts, Elizabeth Warren.
Thanks very much. It's good to see you all. It's good to be here. Hello, old friends, new friends. Thank you, David, for the introduction. It's good We are 141 days away from when voters will decide the direction our country takes on abortion, climate, and immigration. Another fight with huge consequences is also teed up, the fight over taxes. In 2017, Donald Trump signed his only major legislative achievement, a $2 trillion tax cut, sucked up mostly by millionaires, billionaires, and giant corporations. You know, the guys that Trump is now begging for money to pay his legal bills and to fund his campaign. So in 2025, many of those cuts will expire, and ready or not, Congress will be forced to confront big across-the-board decisions on tax policy. In the 2025 tax fight, will create a huge opportunity to break with decades of tax-cutting political orthodoxy and reshape the tax code to reflect our nation's values by raising taxes on the wealthy. That's what Americans across the country are demanding. That's what Joe Biden is running on, and that is a big reason that Joe Biden will win in November. Next year, we must raise taxes on giant corporations and billionaires. But let's be crystal clear. If Democrats take the coward's way out and sign our names to a half-baked deal that lets the wealthy off the hook, it will be a huge failure and one that the American people cannot afford. So today I want to talk about why taxes matter. Our tax code determines how much money we have for programs like Social Security and Medicare, child care and public education, and roads, bridges, and upgraded transit systems. Taxes also directly subsidize certain activities that shape our nation. Just one example here. The climate-related tax credits in the Inflation Reduction Act are predicted to create 3.3 million new jobs, including good union jobs. Yes. And establish pathways to deal with the unfolding climate crisis. In short, taxes reflect our values. Taxes show what and who we value enough to collectively invest in. And today's tax code reflects the values of a handful of the wealthy and well-connected far more than the values of anyone else. That's no random accident. For a long time, politicians have approached taxes in completely predictable ways. Republicans have talked about cutting taxes, period. No tax was small enough and no taxpayer was loathsome enough that there wasn't a Republican willing to propose a tax cut just for them. Democrats have been equally predictable. They either agreed meekly that taxes should be cut, or they tiptoed away and tried to change the subject. Our nation has paid dearly for this decades-long gold rush of tax cuts. Programs set to address the biggest challenges facing American families never got a foothold because we didn't have the revenues to pay for them. While other nations invested in universal health care and child care, while other nations built millions of new homes and upgraded their transit systems, and while other nations invested in good, cutting-edge manufacturing jobs, we stayed stuck in a race to the bottom debate over how much we should cut taxes. It is no surprise that the United States ranks 31st out of the 38 developed countries in terms of tax revenue as a share of GDP. Our tax code is now caught in a doom loop. Tax loopholes for the wealthiest individuals and corporations mean the rich keep more and more of their money. And as that money floods to the top, so does power. Growing piles of cash fund growing armies of lobbyists that demand even bigger tax breaks. Cash spent on lobbying hit a record $4.3 billion last year, fueled by billionaires drooling over the prospect of even more lavish tax breaks in 2025. And boy, does it work. One example from back in 2004, researchers found that for every dollar that multinational corporations spend lobbying, they got $220 in immediate tax breaks. Think about that. Wow. So, what are the policy consequences of high-powered lobbying and corporate-friendly senators and reps on both sides of the aisle? Well, we end up with a tax policy that reflects the values of the top 1%, or mostly the top 1% of the top 1%. The tax doom loop also distorts every other part of our economy. Consider business competition in America. Entrepreneurs and small outfits are busting their tails, as they always have, and paying full taxes on their profits. Meanwhile, giant corporations are raking in record profits and mostly not paying taxes. Since the 1950s, corporate profits as a share of the economy have nearly doubled, but their federal income tax bill as a share of the economy has fallen by half, thanks in part to a corporate tax rate that has been slashed from 52% down to 21% and is shot through with loophole after loophole after loophole. In the first 5 years under the Trump tax cuts, 55 of the biggest corporations raked in nearly $670 billion in profits, but each paid less than 5% of those profits in taxes, some all the way down at zero. That gives them a huge competitive advantage and even more money to lobby for even bigger tax breaks. Similarly, billionaires are richer than ever. They're not paying taxes. The top 1% just hit a record $44.6 trillion in wealth. They have now amassed nearly as much wealth as the bottom 90% of Americans scraped together. Billionaires can barely afford to chip in more, but they figured out how to get richer and richer in ways that just don't show up on a tax form. By borrowing against their enormous assets, they support a lavish lifestyle of mega yachts and joyrides to outer space, all without producing taxable income. The consequence is that the top 1/10 of 1% pays just 3.2% of their wealth in taxes every year, while the bottom 99% pay more than double that. And you know, over time, that shift adds up. Back in the 1950s, the bottom 90% paid about 20% of their income in taxes, while that number today has jumped to 25% looking at income. By comparison, in the 1950s, the top 400 highest earners in America paid nearly 70% of their income in taxes, while today that number has been slashed to 23%. And that's how it is that a Boston public school teacher ends up paying a higher tax rate than Jeff Bezos. An infamous tax cheat said long ago, only the little people pay taxes. And who are these little people? Working families. Now, why does this matter? Well, partly, it's just a matter of fairness. Those who have more should pay more. And it's a matter of revenues. Think how different the U.S. balance sheet would look if politicians hadn't slashed taxes for the wealthy decade after decade after decade. But it's also a matter of the kind of nation we want to build. A nation that makes healthcare and home care affordable for families, or a nation that gives rich people tax breaks. A nation that fights the climate crisis so the next generation isn't crushed under skyrocketing energy, housing, and food costs, or a nation that gives billionaire corporations a free ride on their taxes. A nation that supports mamas and daddies who are trying to find good, affordable child care for their children, or a nation that blinks at wealthy tax cheats and their high-priced lawyers. And all of that brings us to 2017. After Republicans in Congress had defended Donald Trump through every appalling racist remark, every assault allegation, and every violation of our Constitution up to that time, they got the payoff, big time. Trump signed a $2 trillion tax giveaway that was mostly aimed at, you guessed it, rich people and rich corporations. But this time, change was in the air. The tax giveaway passed, but for the first time in living memory, every single Democrat in Congress voted against it. Every single one. And then, in 2020, every major Democratic candidate running to replace Donald Trump made raising taxes on the wealthy a centerpiece of their presidential campaigns, including Joe Biden. Enough of the tax doom loop. Candidates were willing to say no to billionaire donors. After Biden won and a deadly pandemic rattled our economy to its core, Biden and Democrats actually delivered. We passed tax policies that broke with decades of bad economic and political orthodoxy, and in doing so, we helped fuel the best economic recovery on the planet. In 2022, we raised taxes on corporations for the first time in 30 years. Yeah! Congress passed my 15% minimum tax on billion-dollar corporations. This tax leapfrogged the usual tax loopholes and put a minimum tax on the profit that these big corporations reported to their shareholders, meaning no more bragging to your shareholders about how much money you made and then turning around to the IRS and saying, we're too poor to have to pay anything in taxes. Democrats also passed a massive funding increase for the long underfunded IRS so that it can take on the millionaires and billionaires who have been holding back about $150 billion each year, money they legally owe under the current system. Early reports from that effort indicate that for every dollar invested, $10 will be returned. And once again, tax policy was a sharp dividing line between the two parties. Every Democrat supported the tax increases on the rich, and every Republican voted against them. Every single one. Of course, we should have done more. Kirsten Sinema agreed to raise taxes on the very largest 200 businesses, but basically no one else. And she kicked up a particular fuss about anyone raising taxes on giant private equity firms. But make no mistake, after decades of tax giveaways to the ultra-rich, even with a 50-50 Senate and a teeny tiny House majority, President Biden and the Democrats in Congress have finally put some points on the board. And that sets us up for the showdown in 2025, when Congress will decide what to do with a huge chunk of the Trump tax cuts when they expire. If Republicans win in November, Donald Trump has already said exactly what will happen. This one we know for sure. He told his, quote, rich as hell donors, his words, not mine, that he will give them another huge tax cut, a, quote, upper class tax cut, and a business class big tax cut. That corporate rate, which Trump had already slashed from 35% down to 21%, why not lower it to 15%? And why not add a few more loopholes for Wall Street or for big oil? The tax code is on the auction block, with favors going to Trump's wealthiest donors. So if Democrats win, what happens next? In the past, we eagerly cut deals with Republicans and gave a teeny tiny tax cut to middle-class Americans and then another big fat tax cut to those at the top. When Ronald Reagan got elected, for example, the Democratic House fell all over itself to make a $10 trillion tax cut deal with him. That is the doom loop in its full glory. Or look at the Bush tax cuts. Why did those cuts cost $8 trillion? Because his Democratic successor, President Obama, cut a deal with Republicans to make nearly all of Bush's temporary cuts permanent. The impact on the national debt was staggering. Right up until that moment, Congressional Budget Office had projected that federal revenues would keep up with federal spending, and debt to GDP would actually decline. But once Obama made that tax cut deal with the Republicans, the federal deficit ballooned. The next chapter in that story was an exercise in five-star hypocrisy. Right after the deal was cut, Republicans claimed to care deeply about the deficit. They then fabricated a debt ceiling crisis, which they used as an excuse to extract crippling budget cuts. Those cuts cost the U.S. economy more than 7 million jobs, and they helped set the stage for Donald Trump's election in 2016. Republicans are running the same play again. It's why they created the 2025 tax cliffs, lowballing the cost of the Trump tax cuts by making them temporary and then counting on Democrats to roll over again and make them permanent. And too many Democrats have demonstrated just how eager we are to compromise. Earlier this year, hoping for an increase in the child tax credit to lift 400,000 kids out of poverty, a very important goal, a number of Democrats agreed to give big corporations $3 in tax cuts for every $1 to poor families. 3 to 1. As it turned out, 3 to 1 just wasn't big enough for the Republicans. They tanked the deal because they believe they can get even more next year, and Democrats won't have the spine to stop them. But Democrats don't need to be suckers this time. We can turn away from our history of bad deal making and double down on raising taxes on those at the top. We can make the U.S. tax code reflect the values of the American people by raising taxes for billionaires and billionaire corporations. That's what Joe Biden is running on for re-election, and it's what the American people are demanding loud and clear. 4 out of 5 Americans support raising taxes on on the rich. That's 80% of all Americans, Democrats, Republicans, and independents. And take a closer look at those Trump voters. Nearly 2 out of 3 voters who pulled the lever for Donald Trump in 2020 say they support raising taxes on the rich. If Democrats played hardball on taxing billionaires, America will be with us. Raising taxes on the rich for other programs makes those programs even more popular. For example, big investment like child care is incredibly popular. But when child care is paired with a plan to pay for it by raising taxes on wealthy and on large corporations, it becomes even more popular, up 4 percentage points overall, and up 7 points with independents and 6 points with Republicans. In other words, when we talk about taxes to pay for the programs we want, we build broader support for those programs. At a time when people have grown cynical about democratic promises, showing our willingness to tax billionaires and giant corporations to pay for those programs strengthens our credibility. A 2-cent wealth tax would pay for universal child care, cancel all student loan debt, make technical school 2-year and 4-year colleges free, create a $5 billion investment in historically black colleges and universities, and give every public K-12 school in America $1 million to invest in the way that best meets their specific needs. When we remind people of that, we invite them to dream big for our children and for our nation, and to reject the answer that we can't make our country a better place because Mark Zuckerberg and Elon Musk don't want to pay taxes. The possible changes to our tax code are not mysterious. Democrats have a long list of ideas on how to raise taxes on the wealthy and big businesses. Raising rates, closing loopholes, strengthening minimum taxes, and investing in the IRS. But equally clear should be our red lines. At the end of the 2025 tax reform process, corporations must pay higher taxes. A typical billionaire must pay a higher tax rate than a typical middle-class family. And wealthy tax cheats must be sweating because the IRS has enough money to enforce the law. Those are our red lines. Democrats have good popular ideas about taxes. All we need is courage. Courage to shake off half a century of running for the hills every time the subject of taxes comes up. Courage to stand up to billionaires and corporate donors. Courage to say to the wealthiest and most powerful people in this country, pay up. Joe Biden has that courage. He is campaigning across this country on his plans to raise taxes on the rich. He stood on the floor of the House in his fiery State of the Union address this year and called out billionaires for paying lower tax rates than teachers, sanitation workers, and nurses. He went home then to Scranton and slammed failed trickle-down tax cuts, promising instead to raise taxes on billionaires and billion-dollar corporations and to keep funding the IRS. And he sent his chief economic advisor out to reiterate the promise that tax cuts for the wealthy will stay expired on his watch. It's time to stiffen our spines. Joe Biden is right. if the 2025 tax bill doesn't call on wealthy people and giant corporations to shoulder a bigger share of what it costs to run this country, then Democrats should reject it outright. And that is true no matter what crumbs the lobbyists toss our way to try to sweeten a bad deal. A little money for poor children or a modest tax cut for middle-class families is still a lousy deal when we can't fund child care or infrastructure because the wealthiest among us are still sucking up billions of dollars in tax breaks. Better to let all of the Trump tax cuts expire than be accomplices to another slash and burn tax bonanza for America's billionaires. It is time to talk about our values and time to get out there and fight for them. Donald Trump is telling his rich donors that he will give them even more tax breaks. He wants to build an America that works even better for those at the top. Democrats should follow Joe Biden's lead and double down on taxing the rich. Tax the rich so that we can build a stronger, fairer America. An America with opportunity for everybody. An America where every kid has a first-rate education, where our transportation system isn't the butt of jokes, and where families aren't bankrupted by one bad medical diagnosis. The American people are telling us that they are ready for a tax code that promotes their values, and Democrats must be ready to deliver. Thank you all.
How about another round of applause for Senator Warren? All right. That was an excellent way to start off this conversation about what are those good ideas that progressives have to raise revenue, to make the tax code fair, to make the tax code stronger, to promote economic growth, and to raise the revenue that we need to invest in our futures. My name is Michael Linden. I'm a senior fellow here at the Washington Center for Equitable Growth. I am extremely honored and excited to be here with what I've been calling the super panel. It's an incredible lineup of folks who have deep expertise in tax policy and who are, in many cases, practitioners who actually have worked in tax policy in various ways. So we are going to get the benefit of their expertise and thinking on some of these big questions that Senator Warren raised. Before I introduce them, and I'm going to do very quick introductions, I do want to remind folks that we will be taking some questions at the end of the panel. We have a big panel. We're going to try to keep this really conversational. We're not going to do presentations. We have no slides. Everybody's laughing. Woo! Yeah. Slides are great, just not in this panel. We will take some questions. So if you have questions, write them down on the index cards. My colleagues will. There's Megan. Megan will walk around and grab them, and at the end we'll take some questions. Okay. Now I want to introduce our panel. Daniel Repp is the assistant professor of economics at the University of Maryland. Let's see, I'm water. Nadia Beckman-Stanley is a tax associate at, I'm not going to pronounce the name of your firm. Skadden. Sorry, my apologies. But she's also formerly special assistant to the president in the Biden administration for budget and tax policy. Yeah, you can clap for her too. Kim Klossing is the chair in tax law and policy at UCLA and former deputy assistant secretary for tax analysis at the Treasury, also under the Biden administration. Natasha Sarin is the associate professor of law at Yale and former deputy assistant secretary for economic policy in the Treasury Department in the Biden administration. And Zach Liskow is professor of law at Yale Law School, former chief economist at the Office of Management and Budget, where I got to work closely with him in the Biden administration. So we have really an incredible panel here. So let's start. My notes. These chairs are interesting. All right, we got this. Okay. So Senator Warren remarked upon the many failures of our tax code that predate, in fact, the Trump tax law, the 2017 tax law. She specifically mentioned the degree to which the tax rates for the very, very top have declined precipitously over the last 30, 40, 50, 60 years. And one of the reasons for that is the way that we tax capital income in this country, right? The way that we tax income that is earned from capital assets rather than labor income. And when we come into this debate next year about the expiring provisions, this is really an opportunity for us to start talking about some of these broader problems in the tax code and not just the provisions that happen to be expiring. And that presents us an opportunity maybe to talk about taxing capital income a little bit more fairly, more smartly. So Nadia, I'm actually going to ask you to start and just give us a sense of how big of a problem is it that we tax capital differently than labor income, and what could we do, big picture, broadly, to think about changing that?
Certainly. So I think any opportunity to talk about tax policy is an opportunity to talk about taxation of capital income, personally, right? I think in every other area we have an agreement that dollars are fungible, right? $1 here, $1 here, they're the same dollars, right? But in the context of capital income, we have in our system elevated the capital dollar versus the labor dollar, right? And it leads to pretty dramatic outcomes. I think that the current system, if you want to break it down, where we have these differences, first you have the rates, right? We have preferential capital gains rates. Second is this question of timing, right? Capital income is overwhelmingly only recognized when the holder of that income decides to, right? They don't have the same restrictions that folks who actually work for their money or folks who have labor income have, right? So they get to decide when they have this income, and that's a huge tax planning opportunity. And then I think those two pieces, and then of course, going along with that timing piece is of course step up the basis of that, right? So that is the reality that if you wait until you die to realize that income by passing it on to your heirs, they have to step up the basis. They receive these assets tax-free. And this is one of the largest benefits that we have for the holders of capital income. So I think of those three as being the big sources of our policy problems with capital income. That is a tax lawyer, not an economist, frankly. And so for me, when I think about ways to deal with those issues, it's about going after distributions. It's about going after rates. It's about dealing with realization of debt. And it's about dealing with this problem, which I'm sure Zach will talk something about too, about the folks who hold capital income have complete control over when they recognize income, and so therefore when they're taxed, and critically if they're taxed.
Well, so that's a great transition to what I was going to ask Zach, because what you often hear whenever people like Nadia bring up this problem is people say, well, that's not real income, it's paper income, those aren't real gains, so we shouldn't be taxing those. But we actually know that for the rich people who have all those gains, it's not really paper gains. They can access the benefits of that increased income and consume it. Maybe, Zach, you have a specific proposal that would go directly after this. Maybe you could just talk a little about what that proposal is and why it makes sense in the context of this discussion.
Yeah, great. So what we propose, this is a paper with Ed Fox, University of Michigan, is closing what we call the billionaire borrowing loophole. So as Nadia said in his seminar before, and pointed out, for the richest Americans, many of them own stock, and it goes up in value, and they're not taxing that until they sell it. If they ever sell it before they die, and many of them will not sell it, and will pay no tax. So from a certain perspective, I suspect, shared by a few in this room, but shared by a decent number of Americans, it's not fair to tax that because they haven't turned it into real money. They haven't really used it. But in fact, many of them do use it in the amount of hundreds of billions of dollars because they borrow. So Larry Ellison, the founder of Oracle, has $150 billion of wealth. And he's a lavish lifestyle. But to do that, he has borrowed about $15 billion, and he's paid tax on almost none of that. So what this proposal would do, raise about $100 billion over a decade, is you tax that borrower. You can say, look, ordinary Americans, when they go out and buy something, they have to pay after-tax dollars. They earn labor income, they pay tax on it. And the same should be true for billionaires like Larry Ellison. He borrows the money, gets the stock, buys the yacht, he should pay tax on the money that he uses to buy the yacht. We've done a survey on this. It actually has considerably more support than other proposals, which are also very good. But I think this one tugs at certain intuitions that this income really should be taxed.
And I think we should talk about this concept of income, right? Just for a second. I know this is a tax, but so we're okay to talk about economic concepts of income, right? But it's important, right? Because when we talk about the effective tax rates for billionaires going down, we typically are also including the fact that their real income does include the appreciation of these assets, stocks or property, or I don't know, art, like the Van Goghs. I assume they all have Van Goghs, several of them. But in real life, the reason I like the proposals act is that it gets at this key point, which is that it really is income for them. They can choose to access the consumptive power of that increase in wealth, that increase in asset appreciation value, whenever they want, by borrowing at, I assume, what are extremely low interest rates. I assume no bank is charging them exorbitant interest rates on those loans. Is that right?
As far as we know.
As far as we know. Maybe they're just getting it under the table.
I don't think they're getting close.
They're getting a good deal. They're getting a good deal. So for anybody else on the panel, I just want to jump on this question of capital income taxation. We're going to hear, this is really for anybody, we're going to hear, okay, sure, fine, Larry Ellison borrows, fine. But at the end of the day, if we tax that capital income, those are the job creators, it's going to hurt economic growth, we can't tax that income. But what do we actually know about the economic evidence when it comes to capital income taxation? What will it do for us in terms of the economy, in terms of the racial wealth gap? I have to imagine that most of these capital assets are owned by legacy holders of wealth. What does it do for concentrations of economic power, as Senator Warren was alluding to? Maybe Natasha, it seems like you want to get on this.
So I think there's something really quite powerful in the way Senator Warren teed up our conversation today, because she discussed this sort of tax policy fight that is upon us about revenue raising, which is super important to fund all of the priorities that she laid out, but also about this core concept of equity and fairness. And that is really at the heart of what Michael is asking about with respect to capital taxation. Unrealized capital gains, this appreciated stock that is held by disproportionately the very wealthy, they make up 40% of the wealth of the top 1%. So that 40% is just never getting touched by the tax code in any meaningful way, particularly when you can afford to borrow against it or not realize your gains and then pass them on to your heirs. That is unfair and inequitable relative to ordinary Americans. It's also deeply inefficient, because it's not necessarily the case that the best allocation of that capital asset, its most productive use, is just to hold it yourself and then to pass it on to your heir in the future. And so I think from the perspective of economic growth, as you were asking about, it really is important to try to address some of these inequities, not just because we're going to raise a lot of revenue, not just as a matter of justice and fairness, but actually because of the distortionary nature that the tax code is currently created, such that there are reasons and ways in which assets aren't being put to their most productive and efficient use, particularly just because of the way that we've structured the code. And I really think that should be like super first order as we start having some of these conversations in the upcoming year.
That's really interesting, because you're making the argument that we should think about capital taxation not just from a revenue standpoint, we should, not just from an equity standpoint, we should, but that there's actually some real reason that we should be taxing capital gains more like regular income for efficiency purposes, and actually could be pro-growth in that sense. That's very interesting. There's going to be some correlations when we start talking about business taxation too. I know Kim's going to have some thoughts about the inefficient way we tax corporations, which could have some similar points. Anybody else have any other thoughts on capital income taxation before Nadia, go.
Yeah, I just wanted to echo this idea that the current lock-in that we have in the capital system is super inefficient, and it necessitates doing capital gains reform across multiple axes. So you can't just do one thing. You can't just change the rates. You also have to do realization of death, because ultimately it just puts more pressure on people to hold the assets. And so I think that when we think about capital gains reform, we need to think about systems reform rather than just one policy change.
And do you think that capital gains or capital income reform needs to be part of the discussion next year?
Like I said, any opportunity to talk about tax policy is an
I
opportunity.
mean, that's a softball. I mean, she's not gonna be like, no, it seems fine. I mean, that would be purple. All right, let's transition to talk about business taxation, because this is another area where it's sort of a different kind of income that mostly rich people have, that does get taxed differently than labor income in many respects. And it's one of the centerpieces of the Trump era tax law, right? It was a massive reduction in the corporate tax rate, as well as a new deduction for business income that is claimed on personal income taxes, sometimes colloquially referred to as 199A, colloquially referred to. Guys, these are the tax jokes. Come on, get with me. It also made a lot of significant changes in international taxation, right? So Kim, I'm going to start with you. You're one of the country's foremost experts on corporate taxation, and maybe the world's experts. What is your 2-minute assessment of how the TCJA has done? We have now 7 years of evidence. How has the TCJA's business tax provisions, how's it done? Has it delivered on its promises? How should we evaluate TCJA and business taxation?
So if you look at Tax Cuts and Jobs Act,
If you look at the Tax Cuts and Jobs Act, there's two really clear lessons from the experience on the corporate side. One is that corporate tax cuts cost a lot of revenue, and they unsurprisingly do not generate enough growth to pay for themselves. Far from it, corporate tax revenues have been down substantially in the wake of Tax Cuts and Jobs Act. A second lesson is that corporate tax cuts disproportionately benefit those at the top, and we see, again, that the main beneficiaries of that legislation are those at the top of the income distribution, like Senator Warren alluded to. What you don't see are big breaks in trends on wages, on investment, or on economic growth. If you look at those three series in the aggregate, and you kind of took some economist who lived on another planet, you said, where was the tax cut? Try to find it on these wage, investment, and growth series, they wouldn't be able to find it. So there's very little evidence that the Tax Cuts and Jobs Act has been successful in that regard.
To what do you attribute that? Why? There were a lot of big promises. They spent $1.5 trillion on the corporate rate cut alone. Obviously, some of that was offset in other provisions, but why didn't it work?
Yeah, I think one important lesson here, and this is an important lesson going forward as well, is that if you look at the corporate tax base, it's not really mostly comprised of little firms, that everyday sort of capitalists that we think of as sort of hanging up a shingle and selling their product. The corporate tax base is incredibly concentrated, so less than 0.5% of all C corps with positive liability are responsible for nearly 90% of the base. So that means that one thing for tax reform in the future, which is that you could raise a lot of revenue by raising the rate, even if you left 99.5% of taxpayers with the current system, because most of the tax base is just those less than 2,000 firms that are holding most of that base. So that explains not just a policy opportunity, but part of what we saw with Tax Cuts and Jobs Act. If you're lowering taxes on firms that already have a lot of market power, that already have a lot of supernormal rents, you're not going to get the same kind of incentive effects that you get if you lower taxes on small businesses. So I think this is an opportunity for us to think about efficiency and equity again together, right? Because the corporate tax is mostly paid by those at the top of the income distribution, and it's mostly paid by the largest firms. So if you raise taxes just on those largest firms, you can both make a more competitive economy and a fairer tax system.
So this obviously hits me right in the equitable growth feels here, because you just said, right, that you can both raise efficiency and equity at the same time. For years and years and years, we were told those are trade-offs. You can either have more efficiency or you can have more equity. You can't have both. And what we heard both with capital income taxation and now on the corporate is actually you can have both, and you should have both. You should have a more equitable tax code that also promotes more efficient use of capital and more economic growth. So now the rate cuts don't expire next year. So there's going to be some people who say we shouldn't be talking about corporate. It's not even on the table. What do you say to that? Should corporate be part of the discussion as we go into next year?
Yeah, corporate absolutely has to be part of the discussion. Not only is there efficiency and equity gains here, but there's a lot of revenue on the table. And there's also a great time to think about tackling some long-held challenges in this sphere. So one of the difficulties with reaching those really big firms that have that extra above normal profit is that those are also the most mobile multinational firms. They can shift their profits offshore, they can offshore their activity, right? But we're in an environment right now where the entire world is moving to adopt a country-by-country minimum tax on multinational company income of 15%.
Something people thought was impossible 10 years ago.
Impossible.
Right?
We got the entire world basically to agree.
When you say basically, who's not agreed to it?
So by OECD calculations, 90% of multinational income is already covered. But the United States isn't quite compliant with that yet, but that doesn't mean our companies won't be affected by it, right? So because the whole world is moving forward with some minor exceptions, that does give us the opportunity to address this issue in the United States without raising the sort of boogeyman competitiveness concern. Because historically, when we try to address profit shifting and offshoring, everybody would be like, well, you can't do that unilaterally because our firms will be disadvantaged relative to firms in the rest of the world. Now that the rest of the world has moved, this makes it a lot easier for us to truly tax these big companies without worrying about all the profit immediately going offshore, because the new bottom at offshore is 15%, not zero. So that gives us more space to address these long-held problems.
This is a good transition. I want to ask Daniel a question here, because you've done a ton of research on the ways that very wealthy people can use business structures, whether corporate or more often pass-through entities, to shield some of their income. And we did just have a large tax break for this kind of income. And I'm wondering if you could talk a little bit about how you would like to see some reforms to business taxation to address some of the concern. Maybe you could spend like 30 seconds or 60 seconds on what you found in your research, and then explain how we should be thinking about how to reform some of this business taxation so that rich people can't use those as essentially fancy tax shelters.
Okay, sure. So factually, as some of you may know, Kim was talking mostly about C corporations who pay taxes out of their own income. Closely held or private businesses tend to be taxes pass-through businesses, where the income of the business is taxed to the owners. And so among very high wealth individuals, what we see in the data is this is a really important source of income in these businesses. So it's like a third of individuals' taxable income at the very top of the income distribution, and it can be quite complex in the way that people receive it. So not only can you own a business and that business makes money, but you can own a business that owns other businesses. You can own a stake in a partnership, and one of the partners can be a private foundation that you control. And anywhere that there are differences in tax rates due to the difference between capital and labor income, or the preference for when you want to time your receipt of income, that creates opportunities not only to kind of exploit these differences with sort of known loopholes, but to create your own loopholes by adopting increasingly sophisticated ways of owning these assets. So the first and most important thing that Congress can do to address this is to continue to fund the IRS. don't blink in response to the pressures to claw that back. This is why that's necessary, because in order to audit a very high wealth individual, you have to audit not only that person's tax return, their business's tax returns, and so on. And as well, this can get into the weeds, but you know, some of this behavior, the way that people try to dodge taxes, is not unambiguously illegal. And so the IRS on its own, even with a lot of funding, is going to have some difficulty in clawing back the exploitation of some loopholes. And Congress has a role there in preventing those loopholes from existing in the first place. You get way into the weeds on how they do that. Those are the two main things that I think Congress should do.
I am tempted to get into the weeds.
Yeah.
But, okay, so resisting that temptation for a moment. So is it, on balance, is it deduction that goes to that kind of business income, which was part of the Trump tax cuts, right? There was a 20% deduction on business income that goes, this business income that is passed through onto their personal returns. Does that incentivize more of this separate tax planning? Does that have no effect? Is it orthogonal to the question?
I mean, just about anytime you create a new class of income, you create opportunities to try and play these games, and I think 199A is a part of that. The obvious game you can play is to, you know, report the sector that you're in differently so that you qualify for this, and then things can get more complicated from there. But yes, it's far from the only problem.
Far from the only, right? So it's one of the, it's added fuel to the fire. But as we were talking about, there's the existing problems in the tax code that we should be thinking about an opportunity. This is an opportunity to address rather than just throwing more tax breaks at mainly millionaires, which is, I think 50% of the benefit of 199A went to people making more than $1 million. So that's not exactly a small business tax cut. But you mentioned enforcement, so I want to use that as a really good transition to talk about part of tax policy that, again, it's not necessarily, there's nothing expiring next year that would force this conversation, but I think we have been running a little experiment in the last 2 years where we finally gave the IRS the resources it needs. We heard Daniel just talk about ways that the rich can use their entities to shield their income. So I'm going to start with Natasha. I bet she knew I was coming to her with this question. Why, beyond an equity, this is obviously the theme here, beyond the equity and the revenue implications, but I want to come back to those. What is the case for funding the IRS to ensure that rich people don't get away with the kinds of shenanigans that Daniel talked about? I think shenanigans is a technical academic term. What's the case? When you talk to people, I know you've talked to a lot of people about this, and spent a lot of time working on this question. Is there a case beyond the revenue and equity? Is there just what's the argument for it?
So I actually want to start by, this is a great question, I want to start by kind of highlighting some of what Daniel just discussed with respect to pass-throughs and particularly large complex pass-throughs, where the IRS has been, until the Inflation Reduction Act, which was a historic infusion of resources to the agency, the IRS has suffered decades of funding cuts and an inability to perform the basic services of the tax administrator in the way that it should be able to. In the case of complex partnerships, what that's meant is the audit rate that the IRS has for looking at, trying to examine and trying to understand these structures and the nature of the loopholes that are being exploited, but also the illegal evasion that exists. The audit rate was literally 0%. So in that world where the audit rate is 0%, you can understand why incredibly well-resourced and incredibly well-equipped sort of pass-throughs and also their well-compensated tax advisors have a tremendous incentive to try and push the lines with respect to what they decide to report and what they decide to ultimately pay taxes on. That creates huge inequities, right? So that's not an opportunity that's available to those of us in this room who make wage income that's automatically deducted, our tax liabilities are automatically deducted from our paychecks. But it also creates these deep inefficiencies and frankly has huge anti-competitive effects in the economy. How so? If you sort of look outside the IRS and it says, all the Wendell Holmes taxes are the price we pay for a civilized society, if that's what you believe as a partnership owner, as a sort of small business owner, that's what you think, then you're fully compliant with your tax obligations because that's what you believe you should be doing. if you're the kind of partnership owner that doesn't actually, or partnership stakeholder that doesn't actually have that ethos, well, you have at your disposal ways in which to be much more competitive than your counterpart who decides to comply with their tax obligations because you can just skirt the law. And that sort of incentive that we've embedded into the tax code is actually one of the reasons why I think some of these reforms and fundamentally funding the tax administrator to be able to do its work, which is to make sure that people are complying with their tax obligations in a sort of effective and efficient way, why that's so first order. It's not just about revenue and it's not just about fairness, it's also about pro-growth policy. And the other thing I just want to point out in this regard is that all of this is already working. And so the IRS today, actually, Rich Rubin just wrote about it, the IRS today decided that it was going to invest very substantial resources in closing a particular type of loophole that large partnerships exploit called partnership basis shifting. We don't have to go into exactly what that means, but what it means is that
People are clamoring for you to go into exactly what. Every comment.
Yeah.
She'll explain.
What it means practically, and they've also created a new division that's focused in the Office of the Chief Counsel that's focused exactly on these types of entities and putting resources behind these questions. Every dollar that the IRS has spent so far from the Inflation Reduction Act on enforcement has generated more than $7 of additional returns. Where do you find a 1 to 7 ROI these days, just like lying around? You find it by funding the IRS. And one last thing that I'll say, and since Senator Warren is here, I have to say it because she's been a tireless champion for it. The IRS is also investing very significantly in improving the services that it's able to provide taxpayers, and that means things like direct file, which provides all of you an opportunity, or will soon provide all of you an opportunity to directly file your taxes with the agency rather than spending hundreds of dollars and hours each year on tax filing. All of this means that I think it should not just will the IRS and will IRS funding be at the center of a tax policy conversation in 2025? I think invariably it will be, and unfortunately it will be, frankly, because there are a lot of critics of the agency who are looking to defund it. What it falls upon all of us in this room to do is really to push back against all of that, not just because of equity,
Not just because of efficiency, but also because of growth.
but also because of growth, and also because of the importance of a 21st century tax administrator.
So I want to ask two quick follow-up questions. So in the past, when the IRS did not have the resources and there was a 0% audit rate of these incredibly complex partnerships, I know this is a softball, but it's an important point. Who were they auditing?
Oh, very good point, actually. So over the course of a decade, when the IRS's audit rates of large partnerships fell from a very low number, which was 3.8%, to 0, what happened with respect to regular Americans is that, or EITC recipients to take a particular category, is that audit rates shrunk by less than half that. So, and again, that is a resource fact. It takes a ton of people and many audit hours to audit a large, complex partnership. It takes a piece of mail to audit an EITC recipient. And so, while I think there are incredibly important issues that the Inflation Reduction Act and Commissioner Werfel have raised with respect to equity and with respect to low-income taxpayers and enforcement that the IRS is addressing, we also need to keep in mind that these are resource problems that the agency has historically faced that we're now finally dealing with.
Daniel, go ahead.
Sure, okay, I can add a little bit to that. So there's a study that I'm sure Natasha has in the back of her head that shows that under the previous regime, black taxpayers were much more likely to be audited than white taxpayers. And I think my read of that study, totally consistent with what Natasha is saying, is that this is driven by EITC non-compliance audits, and it's more fundamentally caused by the fact that those are the only types of audits the IRS had any type of resources to undertake. So they would send a letter to someone who claimed EITC, and the letter said, well, we're not sure if this is your child, that you're allowed to claim the EITC you get, if this is your kid. Please send us some documentation. The taxpayer doesn't respond. I guess you could interpret that as eliminating non-compliance, and that's what was sort of at the heart of that real discrepancy. And so in turning the corner to do anything differently, the IRS needs the resources that Congress has given.
So how do you make this question about better enforcement focused on the right places, and equitable enforcement and pro-growth enforcement? How is that going to be part of the discussion next year Is it purely a defensive thing? We just need to protect the money that's there. Are there affirmative ideas that we could be trying to push forward to make enforcement and taxpayer services, frankly, to your point, a part of the discussion next year? And this can be for anybody who wants to join in on that question. Nadia?
Nadia, go first. Well, the one thing I would say is just to echo what Tasha said. 7 to 1. Like, you don't get a 7 to 1 ratio on spending basically anywhere else in budget.
Unless you're a corporate lobbyist, apparently.
Well.
$1 for $300, that is pretty good.
When we're talking about taxes, and I think that it will necessarily be a part of the conversation, or it should be a part of the conversation, simply because at least half of the Congress is going to be fighting for extensions of incredibly expensive tax policy, right? And like, there will be at least some whispers of concern about deficit tax, right? If nothing else, like that should beg the discussion at the very least. I think we need to be very careful about how we talk about enforcement, especially when it comes to working communities and communities of color, because it's really easy to forget that the IRS is a law enforcement agency, and it's really easy to forget that we're talking about communities that have been historically underrepresented and then also historically targeted when it comes to their interactions with the IRS. And one of the things that I learned from our 3 years together trying to get money for the IRS was that we need to be more careful about these conversations. We need to be more nuanced. We need to do more with and not for when it comes to advocacy with communities about increased enforcement and what that means. And I would just hope that we would bring the kind of grassroots organizing that the progressive left has had in our back pocket to this conversation about the IRS and enforcement in particular.
So besides continuing to fund the IRS, I think a couple things that would be useful are for congressional staffers, look through like the IRS's dirty dozen list of tax abuses, things that they're trying to fight out in court. It is much easier to deal with a lot of these things with legislation than it is for the taxpayer, or for the IRS to audit someone. They say, you did this conservation easement, whatever tax dodge. We think you like massively overvalued your asset when you did it, so we're going to make you pay that tax. The taxpayer says, well, I don't agree. They take it to court, long drawn out court process, and they have to do that for every single person that they're trying, until the curve finally bends downward and people stop trying to play these games. That's a really costly way to fight the fight. So with congressional action, you can head off a lot of that. And the other thing is that I think we should look at the penalty structure for non-compliance. Right now, the way penalties are structured almost incentivizes people to go through a tax professional and say, well, I think that I actually thought I was allowed to do that. I didn't know I couldn't do it. And my lawyer told me it was okay. And then when you're in that case, you get a very generous penalty treatment. If you're even in the end, if you're found to be non-compliant, I don't see why above a certain dollar amount we should be that forgiving.
That's interesting. So you're saying that people are willing to, they sort of break the law and they know that at the end of the day, if they get caught, they get a slap on the wrist.
It's fully formalized, yeah.
Yeah, okay.
And just one last thing about the nature of, that's about this.
You're trying to silence the conversation.
Just one last thing about the nature of whether this should be like defensive or affirmative. It's important to note that the IRS has already lost about half of the enforcement dollars that the Inflation Reduction Act legislated. So the types of investments that they're making today, they're not actually going to have the capacity to continue to make over the course of the decade without additional resources. So this is a hugely valuable pay for, to Nadia's point. It also is just a space where we have to invest a lot of time and energy. And I actually think that if you look at what the IRS has been doing as it describes its new enforcement efforts, it's actually heeding Nadia's very good advice. It talks about the importance of making sure when it enforces tax laws, what it means is accuracy on both sides of the ledger. So it means that on the high end, where there's a ton of non-compliance, the top 1% is responsible for 30% of the tax gap. What that means is finding ways in which to curtail that evasion. And what it means for many Americans who today, because of fear, because of concern, aren't claiming all the benefits to which they're entitled to, it means education and advocacy to be able to make sure you reach those communities and get them exactly what they're entitled to and their fair share as well.
So I want to pick up on something Nadia said. That's great. I want to pick up something Nadia said about a broader issue into which this whole debate is gonna. There's actually several big picture issues that we have. We've been focused on corporate, we've talked about business taxation and capital taxation and enforcement. Let's zoom out a little bit to some of these broader issues that this debate is going to be intertwined with. And I'm actually going to start with Zach, because you and I worked together at OMB, and you were chief economist, and I was chief pain in your butt. So Nadia mentioned the fiscal trajectory. She mentioned some fiscal risks, and this is going to be part of the debate next year, the deficit and the debt. And I think you and I have had a lot of conversations about this. And I think it's fair to say that our fiscal trajectory probably does carry some risks. It's a debate that we can have about how big those risks are and whether we should worry about them now or later, or how to worry about them, but there's probably some risks. And we know that the main culprit when it comes to those risks is tax cuts. The senator actually mentioned it, that we had a tax code that was designed to keep up with the costs of our commitments to America's seniors, to people with disabilities, to America's veterans, and then we cut taxes and we no longer have a tax code that can do that. So how important should reducing fiscal risks be to this conversation? Is it a primary overwhelming concern? Is it one of many things we should be thinking about? How should we think about the use of the revenue that is gained from some of these proposals?
Strongly disagree with one thing you said, which is that you were a pain in the butt.
I was about to rush by.
So I've thought about this for a while when I was the chief economist for OMB. My take on this, there are many takes. My take is there is no short-term debt crisis, but there is a long-term concern. And if you look at what the National Budget Office says, we see debt going up and up and up, and it's like, this means that, although it's always the case that we have constrained resources, this is particularly true for the U.S. today because we cannot keep going like we've been going. So what that means is we need more revenue. And the way I look at this is, like, I don't have a particular threshold in mind. Here's how much debt we can have, or here's the amount of net interest that we can pay. The way I think about it is that I look at this bill by bill and consider the cost and the benefits for each bill. So starting with the Trump tax cuts, that's added to a huge amount, or has added and will continue to add a huge amount of debt, which will constrain the investments that we can make going forward. And like Kim said, like, benefits have been pretty minimal. There were some changes in the corporate tax structure that had some benefits. Those have been done. It's good. I think they were done. Immediate expensing, things like that. I think those were good. They've been done. Like, in terms of what can be done next year, like, we can't do that again. So in terms of the tax cuts that Republicans could add to next year, they're just going to be blowing up the deficit, reducing the benefits, reducing the investments that we can make going forward, for quite little gain. In terms of the types of tax increases that Democrats could have going forward, I think we've all been saying that there are a variety of things, many of them taxing capital, but also perhaps raising the top rates, just would not have big effects on the economy. Maybe small, but not big, but could either fund really important investments in infrastructure, in education, housing, many of which possibly good chance actually pay for themselves because they increase human capital and such, or pay down this long-term debt issue that we think we have. So the way I view it is we should definitely not be increasing, or we should definitely not be reducing taxes further on the super rich for not much gain, but it's a good time to consider raising taxes on the super rich and big businesses, or either investments or reducing long-term debt.
Kim?
Yeah, I would add a few things to that. One, I think the interest rate environment is a little different than it used to be. With higher interest rates, I think there are more reasons to be fiscally prudent. I also think that the Tax Cuts and Jobs Act extensions, well, they kind of look like they're helping most of America. Even the rate structure is mostly benefiting those at the top. So I agree very much with Senator Warren's instincts that we should be careful with this one-way ratchet that we've got going, where Republicans cut taxes a lot, and the Democrats are like, well, let's not cut them for the very richest people. but everybody else can have it, because that makes us have less and less fiscal space to address all the needs that you described earlier. Say nothing of unforeseen needs that may be coming down the road in terms of national security or public health or climate change. We have a lot of fiscal needs. So I think we need to look more broadly at the tax system, make sure that our reforms are progressive, but don't hold anything particularly sacrosanct. And Natasha and I wrote a paper last year where we sort of outlined a bunch of things that you can do to raise revenue alongside a revenue neutral approach to tax cuts and jobs act extensions, rather than this hemorrhaging revenue approach that many of both parties seem to be in favor of.
So I wonder, I agree with everything people have been saying, and obviously this is something I've thought some about too. I think we can all agree, and probably most people in this room, and probably most Americans agree, that this sort of one-way ratchet, as you described it, Kim, of we're just going to keep cutting taxes over and over again, undermine our tax code, and then on the flip side, we're going to come back with screaming deficits, and that's why we can't afford to pay for things like, or invest in things like childcare and all of the proposals that Senator Warren has mentioned and others that people have talked about. That's obviously unsustainable, and that sends us in a bad direction. On the other hand, I don't think we want to be overly focused on these potential risks of long-term fiscal deficits and debt when those risks are prospective. They are not. We don't know. You're right. The interest rates today are higher than they were 10 years ago. It was bananas that we talked about deficits and debt 10 or 15 years ago when we were basically the zero lower bound and 7% unemployment rate. Today, 4% unemployment, we're not at the zero lower bound. Okay, fine. But to Zach's point, we don't see any evidence that higher debt and deficits is having these kinds of long-term effects. And if we focus too much on that, does that push us towards things that are going to be economically harmful? Cuts to Medicaid, cuts to Social Security, cuts to Medicare. Those would seem like things that we should be worrying, that we should be bringing into the discussion. How do you balance that concern? If you start talking about deficits and debt, then the other side says, well, that's why we got to cut Social Security.
I think as part of how I look at this is opportunity cost. If you look at the CBO forecasts, they're not that dire over the next decade, but they're based on current law, not current policy. If you add current policy another $5 trillion, that starts to be concerning.
Be very specific. The $5 trillion you're talking about is more tax cuts.
And more tax cuts by extending not just the personal side of the Tax Cuts and Jobs Act, but also various business things that are getting less favorable over time. So is that the best way to spend $5 trillion? I don't think so, right? And I think you and I could agree on there's a whole host of other ways that we could spend $5 trillion, including deficit reduction, frankly, that I think would be better than that. I'm not saying deficit reduction should dominate other important fiscal priorities that we might have, but it seems like this carte blanche tax cuts for all thing is simply unaffordable right now.
Yeah, I want to jump in to say one thing, which is that, it's uncertain how challenging things are going to be fiscally in the future. But if we do end up in the situation where we have a fiscal crisis, the debt is really starting to take its toll, I would rather be in that situation with a public that has faith in the American tax system, so that if there are sacrifices that need to be made, we can have that conversation in a politically healthy way. Whereas, the current situation, I think the way that very wealthy people are taxed, the way that those taxes are enforced is undermining a lot of public faith in a way that if we do reach a fiscal crisis while we're still in that situation, it can get really nasty.
That's a good point, and worth reminding people of my favorite poll result, which is that there are more Americans who are deeply concerned about the fact that rich people and corporations are not paying enough in taxes than there are Americans who think that they themselves are paying too much in taxes. It's a bigger concern for most Americans that rich people and corporations are not paying their fair share than their own tax bills. So that does get to that point. And the other thing I wanted to ask about in this context is, we've talked a bunch of proposals. One of the common themes of the proposals we've talked about are things that are equity enhancing and efficiency enhancing. So they are proposals that would raise revenue and not only not have any measurable economic effects, but might even be positive economically. And that feels like a win-win. That's the why would we not do those proposals. So if you want to address long-term deficits, raising revenue in an economically efficient way seems like the best way to do that. And so capital income taxation, more efficient enforcement, corporate taxation. So what are your favorite proposals? If Congress was like, we can only do one, they should do more than one. But if they can only do one, like what's their number one? Where should they start? Somebody want to take a crack at that?
I'll take a crack. So, how about this? I mean, the number one really is taxing billionaires borrowing, ending the billionaire borrowing loophole, but which is a bill like that could definitely happen, possibly has legs. But I think the real thing that would be great would be ending step up at tech. So we have all these billionaires and millionaires out there who have all these gains in their stocks, and then when they die, those gains are gone and totally untaxed with income tax. Maybe they have to pay some estate tax, but they no income tax. And it's a gross injustice. Leads to intergenerational transfers of wealth that perpetuate inequality. And it's also really, really inefficient. And we're having very, very low tax rates on this form of capital. And while, labor income is taxed and other forms of capital aren't taxed much more. This is one that's been in some Biden budgets, been in some Obama budgets. Like many countries in the world do not do it this way. Canada does not do it this way, for example. Raise a lot of money. You could just exempt $20 million of wealth if you want. 10. You can make sure that even the very rich, even everyone but the very rich wouldn't pay it. But this seems like if I had something I could do.
It's a good one.
I might suggest that, as much as I appreciate that proposal and a lot of the others, that the most holistic way to get to capital income, if you really want to get to all of it, is to start at the entity level. Because part of the problem is we have retirement accounts, we have 529 accounts, we have nonprofit endowments, we have foreigners. All of those things are not taxed, no matter, even if we did all of the perfect reforms, and I like a lot of these ideas, we're still not going to get to all of capital income unless we're willing to start taxing those, and those are very difficult to tax. So if you can start at the entity level, beef up the corporate tax, at least you're getting a bite of the entire apple, and then whatever you can do on the individual side is great too, but sometimes that's harder because taxing an individual can be more politically difficult than taxing a corporation too.
So,
I was going to say what Kim just said, but I want to add one piece to it, which is earlier we had this conversation about whether the corporate rate is going to be part of the conversation, given that it's not an expiration that's upcoming. And we kind of, again, know that it is, right? Because if you look at former President Trump's campaign proposals, which are kind of hard to disentangle, one thing that they're doing lots of sort of wacky stuff. One of the things that is also wacky, but is kind of, we knew they were going to do, is double down on corporate rate decreases. And the view is that the corporate rate should fall from 21 to 15, maybe 20. It's unclear what the precise number is, but it's kind of doubling down on where TCJ has really failed in ways that cost a lot of revenue, but are also, to Kim's point, hugely inefficient. I also want to say one thing on the individual side, because we haven't gotten to spend that much time on it today, and in this sort of framework of efficiency and growth, I think that what should be at the forefront of bipartisan consensus, frankly, in 2025, has to be a very sizable investment in a refundable child tax credit. And why? I know many of you think that, and I'm sort of preaching to the choir here, but I think that not just because it's totally unacceptable that 19 million kids in this country are living in poverty because we threw them back into poverty after the American Rescue Plan's extensions expired, but it's also unacceptable that we're not investing in future generations because we know that is going to pay off. It might not pay off in a 10-year budget window in ways that sort of are computed the way we think about traditional scorekeeping, but it certainly pays off in the future in terms of labor market productivity and health outcomes for those children and those families. And so I think that just obviously has to be first order.
Nadia, and then I want to jump off a question. And then don't forget, in about 5 minutes, I'm going to start taking questions. I have a few up here already. If you have questions, write them down, hand them to Megan. We'll get some questions to this incredible panel. Nadia.
I'm going to cheat a little bit. Rather than a specific policy proposal, I would really, really really hope that whatever is done is sustainable, in the sense that it's more than just a 1-year extension or a 3-year extension. I think that this reliance on short-term tax policy is very detrimental, not just to the tax system, right? Like, it's very frustrating to have to start over again from scratch, it feels like, when we do these major overhauls every time. But also, it's incredibly destabilizing. It's destabilizing for individuals, for low-income folks, for like the folks who were relying on the CTC. To have that pulled back and taken away, that level of instability, it's frankly unconscionable in my mind, right? And I think that because of the deficit conversation, there is going to be a lot of pressure to do 1-year extensions, because whatever you do, the numbers will feel smaller if you do it on a 1-year basis instead of a 10-year basis, or God forbid, a permanent basis, right? And so I really hope that folks approach the next set of tax policy conversations with an eye towards building in a sustainable solution. Because if we have to come back to this over and over and over again, we just lose so much like legislative capital. We lose so much of the work that the folks at the IRS do that takes something from a law to an actually administrable tax system, then becomes sacrificed to the altar of short-term extensions or short-term reforms.
Let me ask one more big picture question, then I'm going to take some questions from the audience. So I heard Senator Warren talk about it. Underlying a lot of what we've talked about, it's been a question of progressivity, about the effective tax rate on the people at the top. And we know that the effective tax rate on the people at the top has come way down through a combination of capital income taxation, the differences, corporate, the major shift in corporate taxation, lack of tax enforcement, all the things we've talked about. So one question I have for all of you is, how important a goal is it to simply, for its own sake, raise the effective rate of people at the very top, 1%, top 1/10, 1%, top 1/100th of 1%? Should that be a North Star that people should think about? That at the end of the day, that line that shows the richest 400 billionaires' effective tax rates coming down by 50 points over the last 50 years has got to start going back up. Anybody want to take that one?
I guess I view that as a good thing to do because it's something that will probably again have, if anything, small impacts. It might have some impacts, small impact on the economy. Probably small, but raise a lot of money. Like we have a lot of inequality and in this country, and we raise a lot of money. We have lots of investments that would be useful to make. So I think we should do it. So I think that there are lots of useful things to do. Taxing the richest Americans is one of them. So I'd say it's one of many North Stars. I would not say it's the one North Star, along with corporate taxes, international taxes, capital income for those other than the very top. But I think that there's a symbolic element to it. But in terms of, I'd say it's one of many things.
I like the idea of many North Stars. I wonder if that metaphor doesn't quite work. But I do take the point. Not it.
One thing that regularly astonishes me is that, and it probably should, because I've seen the numbers over and over again, is that Americans understand that we have a progressive tax system. Baseline, our tax system is progressive, but it is not nearly as progressive as we all think it is, and it's not nearly as progressive as we all think it should be, right? So you have the tax system where it is, the tax system where people think it is, the tax system where people think it should be, right? This is a lawyer making a bar graph with her arm, so obviously, accuracy cannot be assumed. But I think that alone suggests that, if we want a tax system that represents our values, we want a more progressive tax system at the most, simple baseline level.
And I would just add one thing here, which is the caution and what not to do if you care about progressivity. If we look at the Trump proposals, he's suggesting a massive fiscal switch away from the income tax and towards reliance on tariffs. He suggested concretely a 10% across the board tariff for every trading partner. He suggested 60% on China.
He even floated the idea last week of simply swapping out the income tax for tariffs. One thing we should be aware of is the income taxes are a tool of progressivity, and we fought a fight more than a century ago. We fought a fight to allow the income tax through the 16th Amendment, in part because tariffs are a very regressive and inefficient way to fund a government. And I've done some recent analysis in a Peterson Institute policy brief that I'm going to be building on with a blog post later this week, but tariffs are a very regressive consumption tax. And if you look at the combination of the Trump proposals, they're far more regressive than just a regressive income tax cut, because it's a regressive income tax increase that really hits those at the bottom the most. And the reason it hits those at the bottom the most is because the poorer parts of our society are spending all of their income. So when you tax their consumption, all of it is affected by that. Whereas somebody who can save 30 or 40% of their income isn't going to be paying tariffs on that part of their income. And so I think paying attention to that fiscal switch is something that we should all be doing, because if we replace the income tax, even in part, and you can't replace it completely, it's a mathematical impossibility, but if you replace it in part with tariffs, you're going to be taking money from the poor and the middle class to hand it to those at the top.
And just to connect what Kim just said and what Nadia was saying, our federal tax system is the tax system as a whole in this country is not nearly, it basically is pretty close to flat, actually, if you take into account state and local taxes, especially states that have progressive tax systems. In the federal tax system, only the income tax and the corporate income tax are the progressive parts of the tax system. Payroll taxes and excess taxes are regressive. And it is notable that the last 40 years of tax policy, mainly conservative tax policy, has been to undermine the progressive parts of the tax system. And they barely talk about the payroll tax or the pieces that are regressive. And this sort of tariff for income tax switch, or consumption tax for income tax switch, is very much in line with that. Basically, let's not tax people the way that rich people get taxed, and instead let's tax people the way poor people get taxed. That's really what we're talking about here. And that seems politically bad, but economically disastrous. So I'm gonna ask some questions from the audience. I've got a lot of good questions here. Let me start with this one. So taxes, it's interesting, I can't tell if this is a 19 or 17. Taxes are currently about 17% of GDP. I'm just gonna auto-correct to the number. 17% is about what it is now. Historically, in the last 40 years or so, they've been somewhere in the 18% range. And what you'll hear certainly from conservatives is they can't be any higher than that. 18% is the right level. Should we be thinking about revenue as higher than, what's the right level? Do we need more than 18%? Can we get there?
Yes. And we were at 20 at the turn of the century, right? And that's when we last ran the surplus.
Also, sorry, Zach, but Senator Warren highlighted it. We're 31 out of 38 OECD countries and how much revenue we bring in. Like, obviously, there is space for us to provide substantial more revenues to fund all the important investments that we need to make.
Yeah, it's a question of the country you want to have. And you can look at the evidence. You can look at the cross-country evidence, the cross-country evidence over time. It's just simply not the case that higher tax countries are poorer countries. It's reverse. Actually, the richest countries have the highest tax share of the economy. I'm not saying it's causal, but it could plausibly be. Like these investments that we all think are really important in child care and education, they're pro-growth things. And the society that we think we want to have requires more taxes.
I think that's, I certainly, you persuaded me. I was unpersuaded before, but now I'm in. But it is notable, right, that in the turn of the century we had tax revenue of roughly 20% of GDP. And last year it was 16.5%, it's about 17% this year. That's a 3 percentage point change from tax cuts, and that's an enormous change. We could certainly go in the other direction without. I don't think 1999. I don't think people look back at 1999 as an economic hellscape. I think.
Party.
What's that?
It's a party.
By the way, the tax gap is 3% of GDP on an annualized basis. I'm not saying you can collect all of the $600 billion plus that we're missing each year in owed taxes already, but you can collect a sizable portion of that, and that'll make a big difference in your number.
But Natasha, the job creators. Okay, here's a question. This is a great question. Okay, so Kim, you said that the top 2,000 corporations make up 90% of the corporate tax base. Is there do we have similar research on large partnerships and pass-throughs? Are there a relative handful that make up the largest share of total partnership or pass-through income? Do we know that?
So I don't know exactly that number, but we have lots of data that suggests it's probably a similar story. So I think I may have said earlier, the pass-through income is about a third of income in the top 0.1% of the income distribution. And so it's the large and complicated partnerships are like meaningfully different. Like so a typical partnership, if you just were to go to the tax return data and pull one at random, is likely to be like a high-skilled professional, a doctor, a lawyer type. If you pull a typical dollar out of that data, that's going to be a complicated partnership, likely in the financial sector, a hedge fund, that type of thing. So I don't have the exact number, but it's a similar story. Yeah.
I think it's fair to say that the partnership income distribution follows the general income distribution. Is that fair to say?
Partnership income is much more concentrated at the top. Maybe 70% of partnership income is top 1%, and that analogous figure for all taxable individual income is like a little over 20%.
Okay.
Wow,
So we're going to get non-honest ones now.
Well, that's interesting. So when we do tax breaks that are designed to benefit those who have partnerships or other kinds of pass-throughs, unless you specifically design it such that it's not going to people at the top, it's going to people at the top.
Yes.
And just a quick follow-up, did the TCJA deliberately design it so that it wasn't going to people at the top? No. Oh, interesting. That's fascinating. And could we design it differently?
Yes, those are easy.
Amazing stuff. I'm surprised at how, I knew that it was more concentrated to the top. That's compelling, right? 70%, something like that.
That's why it's a major driver of income inequality as we measure it in these individual tax students.
Sorry, somebody wrote like a book. This seems interesting. Okay, I'm gonna read it. Ready? What empirical evidence do we have to show the tax code is more than a conversation about revenue? I've heard critiques of legislating through the tax code that there are other more potent ways to shape corporate behavior other than relying on the tax code. On the other hand, others have pointed to the design of the tax code as driving behavior by companies that is rent-seeking or extractive. So that's a great question. So how do you think about using tax policy to incentivize productive behavior or disincentivizing unproductive behavior? And is the tax code the right way the right tool for that? Great question.
The tax code is one of our only levers of really influencing corporate behavior, and that's part of why it's really important to keep corporate tax. Like, let's say we want to encourage clean energy. It's much easier to do that by having a tax cut on an existing tax, and if there was no tax, you have to send checks to companies, and that's much harder to do. But even when you turn to issues like market power, it's true we have antitrust laws, and I'm grateful for those, but those are a very slow and tedious way to address market power. And we have a tax system that's doing the opposite, which is kind of fueling market power by providing low tax rates for those companies that are largest and have the most flexibility about where they park their income. So I think rectifying that situation is a more effective move towards some of the goals of antitrust than antitrust itself can offer, even though I wouldn't suggest doing away with antitrust. I think the tax code can do a lot better towards those aims than it is presently.
And at the very least, they should be working in concert, right? You certainly don't want to have a regime where you're trying to address corporate power through legal means and antitrust policy, and at the same time incentivizing companies to get bigger and to muscle out their competition and rewarding them for that. Those are working at cross purposes. And what do we know about the TCJA's corporate rate cuts in that respect? Do we have any evidence on whether it rewarded? For example, did it reward companies for keeping their prices high? Did it reward companies for extractive profit behaviors?
Certainly the more profitable company you were, the bigger the benefit from Tax Cuts and Jobs Act, so that's very clear. I do think there's some more nuanced parts of it in the sense that the rate cut together with the GILTI had some mixed effects. So the GILTI is a global intangible light taxed income tax that did raise somewhat the tax on foreign income of those companies who had succeeded in getting it all the way down to zero. They weren't quite at zero, they were a little higher than that. So that actually was kind of a step in the right direction. If you want to say a positive thing about passing some Jobs Act, and why not, since I haven't heard one yet. That move was a step in the right direction. I just don't think it was a big enough step in that direction. And I think we can do better and strengthen the guilty substantially by making it country by country and raising the rate.
The one thing I would add here is that regardless of the sort of efficiency of the tax system as a tool for creating incentives, it's the system we have. And the more we rely on, say, reconciliation bills to make policy, the more we are going to be stuck with tax policy as the mechanism. So it behooves us to be really thoughtful about how we can use tax policy. I think you see some of that in the IRA energy credits, using tax policy as labor policy, using tax policy as industrial strategy. There were no other sort of trains that those policies could go on in the way that they did. So regardless of whether or not it's the most efficient, it's the tool that we have, and the tool we have at hand most often.
Well, so, and what's your judgment about that? Is that good, bad, neutral? Is you got to get on the train that's moving?
I think that my judgment is neutral. My judgment is how can we do the most good for the most people the most quickly, and so you use the tools you have. I didn't start my life as a tax lawyer, but I became a tax lawyer because
You weren't born a tax lawyer, is what you're saying?
I didn't start my policy career as a tax lawyer, right? So I started my policy career in income supports, in the social safety net, in SNAP, TANF, and the sort of state look-like programs that support low-income families and kids. And it became clear to me early on that if I wanted to be able to do that well, I needed to understand the revenue side and do that well. And so I've always come to it from a really tactical perspective, or really like as close to the ground, how do we get things done perspective. And tax policy is the train that's moving. There is a lot of room for regulatory work, like, don't get me wrong, but if there are problems we want to throw money at, tax policy is the train that leads us.
All right, so we have time for this. My last question comes from the audience. You set this up perfectly. It's the train that's moving. We're going to have a debate about this. There's going to be a tax policy debate in Congress next year, no matter what happens in November. It is going to happen, and it's the train that's moving. So, in the immortal words of Natalie Beck Stanley, if we want to do the most good for the most people the most quickly, what are the key principles? What should they be thinking about as we, as they go into that train that is literally going to move and follow the many North Stars?
I think sort of just like big picture principles, it's important to emphasize that tax policy is like at the forefront of the conversation this November. And really you have two fundamentally different visions for what tax policy should be going forward in 2025 and beyond. You have one that is very focused on delivering benefits to those at the very top of the distribution, sort of doubling down on tax cuts that haven't produced the kind of growth they promised, and that is sort of the Trumpian vision, and also regressivity with respect to how the code should evolve by sort of consumption taxes disguised as tariffs that are fundamentally about making those at the bottom pay more, not less. And then on the flip side, you have a vision for a substantial revenue raising from those at the top of the distribution who today aren't paying their fair share to fund fundamentally important priorities with respect to our children, with respect to our climate, with respect to our future. And I just think I've been really thrilled to see the Biden administration kind of making clear that this is a fundamental choice that faces voters. I think we can't double down on that enough in the months ahead and in the years ahead, because that choice is sort of obviously clear and stark when you frame it in that way, like which side you want to be on. But if you disguise it as this conversation about one side wants tax cuts and one side wants some tax increases, you kind of lose the plot with respect to equity and efficiency and fairness, and with respect to a tax system that's able to deliver on its multi-pronged goals. And that's kind of what I would like to see in the year ahead.
So we'll focus on whose side you want. It's a pretty good shorthand. Any last thoughts from my incredible panel of colleagues? All right, I want to thank all of you very, very much for this wide-ranging conversation. I want to thank the audience for an incredible set of questions. I'm sorry we didn't get to all of them. There are literally 6 or 7 more here that I wish we had time for. But thank you all so, so much, and we look forward to many more of these conversations in the next 18 months and beyond.
Thank you so much. Let's give the panel another round of applause. I'm Janelle Jones, Vice President for Policy and Advocacy at Washington Center for Equitable Growth. And we are almost there. We have had a fun Monday afternoon of tax reform, and we have one more speaker left. I'm super excited to welcome Daniel Hornig, who is the Deputy Director of the National Economic Council. And I know that you will have some interesting thoughts to share with us on how tax policy is at the center of the fight that we're going to have this year and next. Daniel.
Well, it's great to be here today, and it's a particular honor to follow Senator Warren and such a great panel, including many friends and former colleagues. The expiration of the individual provisions of the Trump tax cuts really presents, I think, a generational opportunity to not just correct the failures of that law, but really to reorient our tax system towards shared growth and economic opportunity. To address structural issues in our tax code that have long preferenced wealth over work, to adjust to demographic shifts that really do require us to raise more revenue, and critically to really ensure that we can sustainably invest in a range of critical priorities that will benefit those in the bottom and the middle of the income and wealth distributions. So I'll start with, I think, critically the failures of the Trump tax cuts that I think really ground where we should start in 2025, and then I'll talk a little bit about the kind of tax system affirmatively that this president thinks we should be building, and the kind of economy as a result that he thinks we should be building. So as I think was very well established in the last panel, the Trump tax cuts just failed on their own terms. They failed to deliver gains in income, gains in economic activity, and gains in revenue that proponents of the bill said it would deliver. And instead, they really were a large windfall for high-income households and large businesses. Let me just go briefly through each of those. So in 2017, proponents of the bill said they would mainly benefit typical Americans and boost wages. We know that the top 1% got a tax cut that was 50 times larger than households in the middle of the distribution. We also know that the corporate rate cut failed to trickle down. One rigorous analysis found that corporations used the windfall to buy back stock, to pay dividends, to boost executive pay, but the bottom 90% of the income distribution did not see an increase in wages. Similarly, proponents of the bill said they would double or even triple the economic growth rate. We know that's not true. Real GDP and fixed investment grew at about the same rates in the 2 years after the legislation as in the 2 years before. And then finally, the bill's proponents claimed that it would increase revenue and fully pay for itself. We know, of course, as we discussed in the last panel, that revenues as a share of the economy have gone down since the bill passed and are lower than projected before the bill passed. And of course, every estimate of the bill shows it's substantially deficit increasing. Despite the failures that are quite clear at this point, congressional Republicans have really made it their top priority for 2025 to fully extend the TCJA, including for the very top. They've also floated a number of proposals that would really build on the true failures of that legislation. A few of them that we've already discussed, things like cutting the corporate rate further, and then last week, of course, applauding the idea of entirely replacing the progressive income tax with progressive tariffs. We know that's nearly impossible, but if anything like it were to happen, we know that it would be a massive shift of the tax burden from the top of the distribution to the bottom and the middle. We also know that it would likely require a tariff rate so high that consumer prices and interest rates would likely go up, burdening the bottom and the middle as well. We also know that extending the Trump tax cuts and the related provisions that are expiring would cost nearly $5 trillion over the next decade, and congressional Republicans have not at all said how they would pay for it. In addition to the regressive tariffs that they have floated, they have proposed things over the course of the last year, like draconian cuts to Social Security, Medicare, and Medicaid. major cuts to non-defense discretionary funding that would take that portion of the budget to well below half its historic average, reversing this administration's progress in combating climate change and building a durable clean energy industry here at home, or simply adding the cost to the debt as they did in 2017, which of course sooner or later would likely mean the middle class and low-income households bearing the burden. So obviously, President Biden rejects this regressive, anti-growth, and fiscally irresponsible approach. But the more interesting question, and I think the question that we're all here today to discuss, is what kind of taxing system and what kind of economy we want to use this opportunity in 2025 to build. As my boss, Bill Brainerd, discussed a few weeks ago at Brookings, there really are 5 principles that will be guiding our approach. The first is that our tax system should be more fair, promoting economic opportunity and work, and eliminating where we can preferences in the tax system for wealth. So to start, the president is committed to ensuring that every household in the bottom 95%, so those earning $400,000 or less, are protected. But we must go well beyond correcting the Trump tax cuts failures and really seize the moment to promote economic opportunity for the middle class and for those in need. So a few examples. President Biden is proud to have expanded the premium tax credits, which lifted health insurance coverage rates to record levels across demographic groups. The expansion will lapse without congressional action by the fall of 2025, so action there is top of his priority list. The expanded child tax credit, which we've talked a lot about, cut child poverty nearly in half in 2021, primarily by allowing low-income families to access the full credit. Restoring it would lift those children out of poverty again and cut taxes by an average of $2,600 per year for 39 million families. And I think that the Senate should also make a down payment on this expansion this year by passing the bipartisan tax package that would lift an additional 500,000 kids out of poverty. Finally, restoring the president's expansion of the earned income tax credit for childless workers would cut taxes by an average of $800 per year for 19 million low-paid workers, lifting roughly 6 million of them out of poverty. But in addition to expanding opportunity, we can make our tax code fairer by eliminating preferences for wealth. That, we think, begins with allowing the Trump tax cuts that went to households above $400,000 to expire, and not bringing back deductions or other tax breaks for those households. There simply is no reason we can look at our economy right now and justify tax cuts for millionaires. But we should go further here too. Billionaires pay an average federal tax rate of just 8% on their true income, a lower rate than many middle-class families, primarily because most of their income comes in the form of returns to capital, which is taxed at a far lower rate than wages if it's taxed at all. The current system also allows the wealthy to avoid capital gains taxes entirely on massive amounts of income simply by holding assets until death. These preferences in the tax code tilt the tax system in favor of wealth, exacerbating income, wealth, and racial inequality. The president's budget addresses these distortions and promotes greater efficiency and equity by taxing capital gains at ordinary rates for income above $1 million, applying a minimum tax to the wealthiest Americans' full economic income, and closing the step-up in basis loophole for the wealthiest households. Our second principle for 2025 is that we should raise revenue in order to fund critical national priorities and reduce fiscal risks. President Biden strongly believes we must raise more revenue to meet commitments we've made to our seniors. Because of the aging of our population, federal revenue as a share of the economy should be rising, but because of the tax cuts that we've had over the last 2 decades, the opposite has happened. Raising additional revenue will also ensure we're able to invest in national priorities that will help us achieve shared and durable growth, including narrowing racial wealth gaps, reducing poverty, investing in children and education, establishing a robust care infrastructure, building more affordable housing to lower housing costs, reducing healthcare costs, and so much more. But I'll also add that raising revenue is just necessary because past Republican tax cuts have increased risk to our long-term fiscal health, with revenues now running below historical averages, even when, like now, the economy is strong and unemployment is low. The additional revenue called for in the president's budget would stabilize debt deficits as a share of the economy and maintain the economic burden of debt within historic ranges. And doing so really is likely to substantially reduce the long-term risk of a fiscal adjustment that would likely be borne by low and middle-income households. The third item that we need to prioritize in 2025 is we should be asking more from corporations that are making record profits and paying less as a share of the economy and less as a share of overall revenue than they have historically. The corporate share of revenue has fallen from around 30% of GDP in the 1950s to well under 10% today. As was discussed earlier, it's also at about 1.6% of GDP, just half of the OECD average of 3.3%. And we all know, despite where we are on corporate taxes, we lived through a period where corporations have experienced record profits, and those profits have not come down even as the pandemic has faded behind us. The president's budget would raise the corporate rate to 28%, halfway back to the previous 35%. In addition to other base broadening reforms. And we really believe that the lackluster response of the lackluster investment response of the corporate rate cut in 2017 shows that we have substantial room to raise more revenue from corporations while continuing to grow our economy. Fourth, taxpayers should pay what they owe and play by the same rules. And this really does require an IRS that has the resources to identify and go after tax evasion at the very top, and that has the resources to provide a smooth and efficient filing experience for taxpayers who are playing by the rules. After a decade of severe underfunding, President Biden's investment in the IRS is paying off. We successfully piloted this year the direct file tool that will be a permanent tool going forward. The IRS has collected over $500 million in unpaid taxes from delinquent millionaires and has launched new initiatives aimed at high-end compliance, including my personal effort, an effort to audit personal use of corporate jets. Just this morning, Treasury and the IRS announced new steps to stop large businesses and the wealthy from engaging in complex and opaque transactions where they shift the basis of an asset between related partnerships in order to unlawfully claim increased tax benefits like depreciation over and over and over again. Clearly unfair, and the IRS and Treasury are now going after that. President Biden's investment in the IRS will lapse without congressional action, starting with the IRS's taxpayer services cliff in 2026. We also know that congressional Republicans have made the IRS a target in every budget fight, and so the administration really will prioritize blocking those misguided efforts and also extending the IRS investment when we get to the 2025 tax cycle. Fifth and finally, our tax system should avoid an international race to the bottom. The administration negotiated a historic agreement signed by 130 countries that will level the playing field for American small businesses that can't afford expensive tax minimization strategies. The agreement will also better support American workers by making it harder to ship jobs overseas and by enabling the United States to collect more tax revenue from corporations instead of from labor and income. Many of the world's largest economies are implementing this transformative agreement, and we should join them in 2025 to grow our corporate tax base and make sure we're able to raise corporate revenue across the world. In sum, President Biden's plan would correct the failures of the Trump tax cuts, but it would also seize the opportunity to reorient our tax system and economy overall in order to achieve shared growth and economic opportunity. Next year's tax debate, we believe, presents a moment of possibility that we should all seize together, bolstered by the economic evidence that we've discussed here today, but also critically by the support of the American people, who overwhelmingly believe that our tax system and our economy should work better for the middle class and better for those in most need. Thank you so much.
That was as great as I thought it would be. And with that, we've reached the end of our events. Thank you so much, everyone, for joining us at our event, The Promise of Equitable Pro-Growth Tax Reform. We hope that you are feeling some of that promise, some of that optimism about the tax debate that we have coming up. I want to highlight what Senator Warren said at the beginning. We are a wealthy nation with ample resources
to improve people's lives and improve overall economic outcomes. Those two things are not at odds. We can certainly do both. And we've heard some of the great ideas from the panel this afternoon. We are very fortunate at Equitable Growth to be part of a tax community of organizations that are working with us on this. We want to thank them all. Special shout out to Barat from her team, who could not be here today, but was instrumental in getting this event, to Groundwork Collaborative, which helps to financially sponsor this event and has been just a stalwart partner with us. And we also want to tell folks for sticking around to the end, there are treats in the next room to take with you. Stay hydrated. Thank you for coming. Oh, and if you like this event, go to equitablegrowth.org/donate. Thank you all.
Thank you.